Owning an ETF is often less than 0.05% of your investment average, but you can make over 10% on it in the end. Index funds also have no fees and commissions per transaction, so they are better suited for more returns. For today's video, we will tackle index funds versus ETFs and share which one to choose based on 4 categories. Let us get started. Number 4. Minimum buy-ins. ETFs have a lower entry price than index funds, and one can purchase a single share of ETF. Of course, some brokerages sell fractional shares. On the other hand, index funds have a few $1,000s as minimum buy-in. In this regard, depending on your income levels, we might see what works for you. Index funds are for premium investors, while ETF investing is an open door for everyone. Although we must add that lately, some online brokerages do not have minimum buy-ins for their index funds, and that might make index funds for beginners attractive. Although ETFs have low entry prices, they might have more charges on transactions. There are broker commissions and first-time purchase fees, although the actual purchases are below 0.05% of the average annual investment. We will present more on this shortly. Number 3. Taxation. The ETF structure is quite simple to follow. To answer the question, what is ETF investing? It is a tax-friendly investment structure where one sells directly to a buyer who supplies funds. Therefore, the seller pays taxes on the capital gains only, except under unforeseen circumstances where there could be a 0 to 20% tax. Those do not happen. As Warren Buffett said, that would be a product of weapons of mass distractions. In contrast, when you cash out of an index fund, you pay for multiple things as if you are selling. In fact, the fund manager has to sell various securities to pay you, and the profits of those sales go to all shareholders. Thus, you are paying capital gains to cash out without selling any shares. Most times, people refuse to cash out because of this reason. Therefore, it becomes a non-frequent occurrence. Still, you might want to consider it as you make your decision. Number 2. Ownership cost. If you are already an investor, you might find these two are the most affordable stocks. We might not have index funds explained to differentiate them from others like mutual funds, but they can sum up to less than 0.05% of your yearly investment. Considering it from the expense perspective, and that you might never have to run out of money, they are both excellent choices for your portfolio. However, there are some nuisance charges with ETFs. For instance, the broker takes a flat rate commission each time you complete a trade. That implies buying and selling. Hence, a regular trader might lose returns. Additionally, when buying ETFs, you pay the bid-ask spread.
Too many.
Although the amount is small compared to your broad market and high-volume ETFs, it is still not available in index funds. In 2019, some companies, including Fidelity and Ally Invest, pulled all broker fees. I think it's about increased investor confidence and another log on the fire around transparency, said Reginald Brown of GTS on CNBC. To decide what works better, find out the commissions, expenses, and other transactional fees before you decide what to pick. If you decide what to settle on, know that regardless of your choice, you are in safe hands for the long run. The long-term average portfolio diversity and low managing cost make both ETF and index funds fantastic passively managed funds. We will shortly share some of the similarities, which are also strengths of these two options. Number 1. Availability. Lastly, it might be easier to find index funds than ETFs. Exchange-traded funds are less available as investment options in many hedge funds and contribution plans. For example, public provident funds do not offer ETFs. Generally, index funds become your only option out of the two. Nonetheless, if you use a defined retirement plan, there are no minimum purchase requirements, as we mentioned initially. Moreover, the National Pension Scheme offers a wide range of ETFs and index funds. Further, taxable investment accounts online provide both. Therefore, minimum investment amounts and the availability of fractional shares can guide you on the fund choice, although index funds are more accessible. Another thing accessible to you is the subscribe button. Hit it now to learn more about index funds and other investment topics. Aside from the differences in taxation, availability, minimum entry prices, and cost of ownership. These two fund structures have many similarities. Investing in ETFs or index funds exposes you to many companies with diverse earning caps. Suppose you invested in the S&P 500. Over 500 large stocks are trading on the market available to you. As such, the funds are managed passively. You do not have to single out any investment and run it. They are all based on an index, thereby reducing the cost of managing the funds drastically. In comparison, active funds, like mutual funds, where the broker has to choose what stocks to invest in, the cost is much higher for the investor. Further, passively managed funds outperform actively managed funds. Since investment is a long journey, one needs to invest in places where the highs and lows would produce positive returns. To illustrate, the annual total return of the S&P 500 has averaged around 10% over the last 90 years. As Buffett said, "This is a low average, but it means you will never run out of money." At the end of the day, index funds have many advantages. If you want more information on index funds and a chance to start investing, here is a guide on how to invest in index funds.